Joining us now, market veteran Jack Ablin with Cresset Wealth Advisors. Jack, investors getting nervous about interest rates. I've looked throughout history and I looked at the four past peaks in the market. We are 12% on the yield. We had 12% yield once, 9% yield once. The most recent time the market crashed, yields were at 4.5%. And going down, by the way. Why all of a sudden is 3% enough to derail a market where the underlying economy is getting so strong?
I think a lot of it, Charles, is the fact that this tug of war that's been going on between stocks and bonds over the last 10 years is that the Fed has tied one arm behind the bonds back. And that's because interest rates are just too low for economic conditions, thanks to all the bond buying that's going on, not just from the Fed, but also the other central banks worldwide.
So why would that change? In other words, if the economy now is, we've gone from what I call a survival mode, if you will, back to a growth mode, and you know the earnings are phenomenal. We're coming out of one of the best earnings seasons ever. All indications are we're going to continue this streak. So there's some justification. We knew the Fed couldn't stay at zero forever.
Right.
So why would the market, particularly experts, be so worried about a move up to 3%?
Well, first of all, we're paid to be worried. So that's part of the bias that you see. But secondly is that we've got a potential growth rate of our economy right now of only about 2%. Our labor force is growing at 0.7, and productivity is running at 1.5. And so when you have Trump and company banging the drum for 3% in an economy that's really only set up to grow at 2%, you're going to run hot. You're going to run out of capacity.
So you don't make allowances for artificial intelligence, big data collection, robots. You don't make allowances for the impact that has, that maybe we don't need the same size labor force that we once had before.
I absolutely do. I mean, if you look at right now, I'm just reporting how the cards are being dealt. So 1.5, yeah. If we get AI, if we get robots, if we get all that stuff and productivity rises to 2.5, then you're absolutely right. We can sustain a 3% economy without it.
I can tell you right now, that Friday, a jobs report that set this all off, that 2.9% hike in wages, I mean, if you look at year-over-year increases in wage hikes, that was really minuscule compared to just a few years ago. And our viewers are so confused why Wall Street is so upset that they're finally getting a little bit extra money in their pockets. I do want to ask you about this also. I want you to take a look at Walmart. We know it had a rough session. I think the roughest session they had in about 20 years. A negative reaction because of the way that the company reported its online sales. 10% down. What do you make of it?
Well, I think, you know, it's going into the deep end of the pool, and it's battling with Amazon in its own space, and apparently it's not working as well as Amazon had hoped. I mean, as Walmart has hoped. Now they've allocated $20 billion to go after Amazon, but Amazon's got deep pockets and a lot of patience, so we'll have to see.
Well,
how that
Walmart has deep pockets too, though, right?
Oh, right. Absolutely.
And by the way, do you own Walmart?
Yes, we do.
Jack, great seeing you.
Thank you.
Appreciate it.